The bull flag is one of the most popular continuation patterns among momentum traders because, unlike reversal patterns, it suggests an existing uptrend is likely to keep going after a brief pause. It forms in two parts. First comes the flagpole, a sharp, often steep rally on strong volume, reflecting a burst of aggressive buying. Second comes the flag itself, a brief pullback or sideways drift, usually sloping slightly against the prior trend that stays contained within two roughly parallel trend lines. This gives the pattern its name, since the shape resembles a flag on a pole. Volume is central to reading this pattern correctly. The flagpole should form on noticeably heavy volume, showing real conviction behind the initial move. The flag portion, by contrast, should see volume contract, since the pullback is generally viewed as profit-taking by early buyers rather than a genuine shift in sentiment. A flag that forms on expanding or heavy volume is a caution sign, since it may indicate real distribution rather than a healthy pause. Confirmation comes when price breaks back above the upper trend line of the flag, ideally accompanied by a renewed pickup in volume. This breakout is typically viewed as the resumption of the original uptrend. A measured move target is often estimated by taking the length of the flagpole and projecting that same distance upward from the breakout point. Though, like all measured moves, this is a rough planning guideline rather than a certainty. Timing matters with this pattern. A genuine bull flag is usually a brief formation, often lasting only a handful of days to a couple of weeks on a daily chart. If the sideways drift extends much longer than that, it starts to resemble a broader consolidation range rather than a tight flag, and the same continuation logic may not apply as cleanly. For risk management, a stop loss is typically placed below the low of the flag itself, since a break below that level would suggest the pullback has turned into something more significant than a pause. Traders studying this pattern also pay attention to the steepness of the flagpole. An extremely vertical, parabolic rally followed by a flag can sometimes be a sign of exhaustion rather than healthy continuation, so context around the broader trend still matters. The main failure mode is chasing a breakout that lacks volume confirmation, or misreading an extended, higher volume consolidation as a simple flag when it's actually something else entirely, like a broader top forming. The bearish counterpart, the bear flag, mirrors this entire structure during downtrends. A sharp decline forms the pole, followed by a brief upward drifting flag before the downtrend resumes. This video is for educational purposes only. It does not constitute financial advice, and trading involves substantial risk of loss. Always do your own research and consider your own risk tolerance before making any trading decisions.